Hi, my name's Dustin and today we're going to be talking about the importance of cash flow within your business. But first, to give you a little background on myself, I am a local Lynchburg entrepreneur. I started my business about 5 years ago, and cash flow is actually a really interesting topic for me. I sort of have a kinship with it. I was a finance grad, and one of my earliest mentors in the finance program used to talk about how cash is king. And it's interesting, from the corporate experience that I had, I worked with a Fortune 500 group, cash wasn't as important to me at a lower level of the organization, but when I stepped out on my own, cash became incredibly important. And so today we're gonna cover why it's important, we're gonna cover a little bit about the statement of cash flows and what it's made up of, and then we're also gonna talk about a cash budget, which is actually used for the financial management of your day-to-day operations. So what is cash flow? Well, in a very simple definition, it's taking a look at the cash inflows versus the cash outflows of your organization. It's really showing the livelihood of it, how you're spending money, how the business is actually operating from a cash perspective. When we look at a statement of cash flows here in a second, you'll see it's broken up into three primary areas: operating activities, investing activities, and financing activities. And really what the cash flow does for us as we look at the statement of it and we look at overall flow within the business is answer questions like, how's the business spending its money? Can it service its debt? And what is really kind of causing changes in the cash position of the organization? So why is cash flow important? Well, as my professor used to say, cash is king. And honestly, looking back over the last 4 years, I couldn't agree more with him. It really truly is the blood or the lifeblood of your organization. And so keeping a close hand on your free cash balance and your statement of cash flows is really important because it helps you understand whether or not you can service the debt obligations and the operating obligations that you have within your organizations. A lot of times, if you're looking at only an income statement or perhaps a forecast that might be too optimistic, you could look great on paper, but if you're not paying attention to your cash balance, you can actually crush your organization. Another way that really the statement of cash flow can become helpful is around making investments or growing your organization. So for example, if we looked at a bakery shop, let's say they had a really small oven, but the demand for their cakes were starting to increase. That would be exciting, but let's say we weren't really paying attention to our cash position. We may have moderate to a slight increase in our cash receipts, but we've had to increase payroll in the organization, which is now starting to reduce the amount of cash that we have at the end of that specific period of time. Well, if we're going to try to grow the organization, maybe there's a piece of equipment that we could buy, like a bigger oven that could produce, maybe quadruple the amount of supply that you could create or the capacity that you could create. Maybe you could even reduce your payroll expense with it. Keeping an eye on your cash balance will help you determine whether or not you can make that investment. And of course, you'd want to look at the cost-benefit analysis of making the investment as well. So that's another way that cash really kind of helps you look at things. It also helps you from, am I going to hit a pitfall? Am I going to hit a period of time? So for 434 Marketing, we're a service-based organization. Let's say one of our larger clients decides to discontinue service with us. Well, if that happens, how are we going to serve the obligations that we have from a payroll perspective, our single largest expense? So really kind of keeping an eye on things, making sure you've got a strong cash reserve and an outlook over a certain period of months is super helpful, making cash flow really, really important for your organization. All right, so what is a statement of cash flow? Well, when we look at one, it's looking at a specific period of time and how the cash has actually translated from that one point to the end point. So when I say specific period of time, I mean maybe a year, maybe a month, maybe a week, depending on when you pull the report and how you pull that report. As I mentioned earlier, there are three main areas to a statement of cash flow. That is your operating activities, your investing activities, and your financing activities. The operating activities primarily consist of your net income. So it's all the transactions that determine your net income. The investing activities are all of the transactions that are affecting any of your long-term assets. So if we use the baker example, essentially it would be the oven that baker would have purchased to put in the bakery. And financing activities, those are all transactions that impact long-term liabilities and equity. And so for example, if you were to take on a line of debt because you're in a negative cash position and you needed that debt in order to keep the business moving forward and keep up with all of your obligations, that would show up there. Now, the statement of cash flow is an excellent, as I've said all along through this tutorial, document to constantly have and constantly review. But on a day-to-day basis, the document I actually find that's more helpful is a cash budget. Now this is used more for financial management opposed to accounting. And so in the next slide, we're going to talk a little bit about what that cash budget looks like and how we use it here at 434 to manage our cash balance. All right, so looking at your cash budget and how to prepare it, one really important distinction between a statement of cash flows and a cash budget is a statement of cash flows really looks at what has happened. It's going to give you an idea of the flow of money over a period of time in history. Whereas a cash budget is really going to help us predict the future. Well, not really predict it, but it's going to help us kind of determine how are things going to go moving forward. And so one of the most important things when you're preparing a cash budget is your ability to assess your receipts. Now what I mean by that is you don't want to take a forecast that's got these inflated numbers of optimism and include that into your budget. The single reason you don't want to do that is it may lead you astray and you might start making investments or increase payroll expenses or buy new inventory or things along those lines when you don't really have the ability to do so. Maybe you have a really strong month, you got a great cash receipt that comes in, but then the next month you're predicting to get something similar and you don't, and you really need that money to kind of weather that storm or the loss that you might incur in that next month. So you really want to get a good handle on your cash receipts and make sure that they are strong and that you've got a good understanding of them. So I've included here sort of a very quick example of what a cash budget contains. First, it's got your cash balance, which is similar to your beginning cash balance, which is similar to your statement of cash flow. Then you've got the revenue or the receipts that you anticipate bringing in for that specific period of time. So that'll give you your total cash available, and then you're going to move into disbursements. So things like payroll, your costs of goods sold, anything around the operating activities that you would report on your statement of cash flows. That's going to give you an idea of your total disbursements made during that period of time and going to give you this either excess or deficient number. Now, if you're deficient, you're going to have to figure out how to manage that deficiency. Is it going to be maybe if you're just starting out, you're not going to pay yourself, or maybe you're going to go and take on a loan. After that, you're going to have kind of your ending cash balance, and that ending cash balance is going to apply to the next subsequent period of time. It's going to become now the beginning cash balance for that period of time. So really at 434, to give you an idea, we update a document that is set off of the same set of principles. It is a cash budget. We update that every single day. And for the periods of time that we tie it to, we actually tie it to our largest expense, which is payroll as a service organization. And so every payroll period, we are looking at our cash budget and we're making decisions based off of that. What I've found that has been really helpful is it points out any deficiencies that we might have in cash coming from the future. And so when I look at how I'm going to predict my receipts, again, that's why it's so important to make sure that those numbers are as accurate as possible, because if a deficit is coming up, maybe in month 2 or month 3, then we need to start looking at ways that we can either shave some cost or start to bring in some capital that can help us weather that storm. So as part of this, I wanted to give some practical next steps, some things that you can put in place. And I've come up with 3 sort of next steps. The first one would be creating a method for assessing your cash receipts. I would caution you here, do not be too optimistic. The rule that we have is if it's not under contract, it's not included in our cash budget. Now we've come up with ways to sort of include forecasts in there so we can paint a little bit of a picture, and included in those forecasts we actually add the associated expenses with it so we can get a better picture of things. But in this case, in the document that I'm going to share as part of this tutorial, I would just recommend coming up with a really good way to harness your incoming revenue and make sure that you're actually going to receive those receipts to the best of your ability. Of course, things happen, but I wouldn't put in things like, oh, we project that our revenue based on last year is going to grow by 50% next month because we had a really strong month. I would be looking at things like, what contracts do we have in place? What things are more predictable? What have we seen from a run rate standpoint? So for example, if you don't have recurring revenue, what trend did you see last month and the previous month? And from there, maybe give a small uptick or keep it completely flatlined. Some people may recommend other things, but I tend to be very real about the cash budget because I don't want to run into an issue where I can't finance my opportunities and my obligations. What I'd rather be able to do is get surprised when we get an excess amount and we actually beat that budget. The second component is I would set up a cash budget. Statement of cash flows is going to look at the history of how you've done. A budget is going to help you prepare for the future. And so I would set something up that is very easy to maintain, something that you could go into each and every day and adjust and just sort of monitor and look at. If you've got an admin, it would be great, to have them send out maybe a weekly email that gives you your current cash balance and any big upcoming expenses for maybe that next period of time. Just so that way you've got it top of mind and you've got a good handle on things and you can address issues as soon as you're made aware of them. And lastly, like I said already, review and adjust all the time. Be in that document, don't just build it and let it sit. Constantly be updating it, constantly be keeping an eye on it, and it'll really help you build a business towards success. Anyways, thank you for your time. I hope this tutorial was helpful for you, and I look forward to seeing you around Lynchburg.